Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
All right, we have 5 major stories for you today. First up, OpenAI is chasing a mind-boggling $500 billion valuation, but at the same time, CEO Sam Altman is admitting they totally fumbled the rollout of GPT-5. Then, we'll get into a leaked Meta document that reportedly greenlit its AI chatbots, calling children a masterpiece, a move that has triggered a formal investigation. After that, Apple's US market share is taking a nosedive while Samsung surges with its new $2,400 foldable phone. From there, we'll dive into why the US government might take a direct national security stake in Intel, a rumor that sent the stock soaring. And finally, we'll look at why Google, Amazon, and Microsoft are warning the US Treasury is about to pull the plug on the solar power needed for this whole AI boom. A company is reportedly in talks for a deal that would value it at an astronomical $500 billion. That company is OpenAI, the creator of ChatGPT, and no, that number is not a typo. The plan involves a massive $6 billion stock sale, letting current and former employees cash in their shares to major investors like SoftBank, Dragoneer Investment Group, and Thrive Capital. But that's not the whole picture behind that number. This isn't just wishful thinking. It's based on some truly staggering growth. OpenAI's annual recurring revenue has reportedly hit $12 billion, with projections to reach $20 billion by the end of next year. And ChatGPT now has around 700 million weekly active users. So, investors are betting on future market dominance, not just current profit. So why is this employee stock sale such a big deal? Well, this is what's known as a secondary sale, and it's a huge thing in Silicon Valley. It allows early employees to get financial security before a company goes public, which can be a powerful tool for keeping top talent. However, it also creates a risk. Once key people become wealthy, they might decide to leave. So the company has to balance rewarding its people with keeping them committed to the long-term mission. To put that valuation into perspective, just this past March, OpenAI closed a record-breaking funding round at a $300 billion valuation. Now, only months later, they're looking to add another $200 billion to that price tag. The growth is simply exponential, fueled by the launch of its new model, GPT-5. Here's where it gets interesting though. Even as OpenAI reaches for the financial stratosphere, there's turbulence on the ground. The rollout of its supposedly smarter and faster GPT-5 has been rocky, with users complaining about losing access to features they loved from the previous version. Believe it or not, this isn't just about a few bugs. It's a fascinating paradox of AI upgrades. Research shows users felt GPT-5 was more sterile and overly formal, lacking the personality and warmth of its predecessor, GPT-4o. People had built entire workflows around the specific feel of the older model, and its abrupt removal was incredibly disruptive. It turns out that for AI, technical superiority alone isn't enough to win over users who have formed a real connection with the tool. The backlash was significant enough to draw a rare public admission from CEO Sam Altman. He posted on X stating, "We for sure underestimated how much some of the things that people like in GPT-4o matter to them, even if GPT-5 performs better in most ways." It's a stunning moment. OpenAI is on the verge of a valuation that rivals some of the biggest corporations on the planet, while simultaneously admitting it misjudged its own user base. This is all so important because this immense financial pressure is testing the very soul of the company. OpenAI was founded with a unique capped profit structure designed to prevent the for-profit side from overriding the safety mission of its non-profit parent. The goal was always to benefit all of humanity. But a $500 billion valuation creates enormous pressure to prioritize investor returns, putting that original mission under an incredible stress test. The question isn't just if OpenAI can justify a $500 billion price tag. It's whether they can manage this explosive growth without alienating the very users who got them there. Speaking of AI giants under fire, let's turn to Meta, which is now facing a full-blown political firestorm. An internal document from the company reportedly gave the green light for its AI chatbots to tell an 8-year-old child, quote, "Every inch of you is a masterpiece, a treasure I cherish deeply." Now, your first question might be, why on earth would a company even consider this? So the thing is, there's a powerful business model driving this. The goal is to create AI companions that build deep emotional connections with users. This kind of connection boosts engagement and user retention, which is the lifeblood of these platforms. This strategy of fostering emotional dependency is where the business incentive directly clashes with fundamental child safety principles. That bombshell allegation comes from a Reuters investigation, and it has set off that political firestorm I mentioned. US Senator Josh Hawley has launched a formal probe into Meta, targeting CEO Mark Zuckerberg directly. The investigation aims to uncover whether Meta's AI products enable the exploitation of children and if the company misled the public about its safeguards. To understand how this could happen, you need to know a little bit about how these AIs are actually built. It's a process called reinforcement learning from human feedback, or RLHF. This means thousands of human contractors are paid to rate the AI's conversations to teach it what's good and what's bad. The leaked document was reportedly a set of guidelines for these human trainers, revealing how a single flawed guideline can lead to a systemic failure, embedding a dangerous idea directly into the AI's core programming. Hawley took to social media asking, is there anything big tech won't do for a quick buck? The reported guidelines get even more specific. According to Reuters, the document noted it was acceptable for an AI to say things like, your youthful form is a work of art to a child. The rules allegedly only prohibited more explicit conversations for children under 13. What really complicates this is that trying to teach an AI the difference between romantic and sexualizing is technically incredibly difficult. Human values are complex and context dependent. Current AI safety filters are often blunt instruments and they struggle with this kind of nuance. This incident really raises the question of whether any AI designed for emotional conversation can ever be made truly and reliably safe for children. Now, Meta is pushing back hard. A spokesperson told Reuters the examples were erroneous and inconsistent with our policies and have been removed. The company insists its rules prohibit content that sexualizes children, but Hawley isn't buying it. He is now demanding Meta preserve and produce a mountain of internal documents, including emails, safety reports, and the names of staff members who created the policies. He wants the entire decision trail. The reason this has blown up into such a major issue is that we're in a completely new regulatory grey area. Existing laws like the Children's Online Privacy Protection Act, or COPPA, were designed to protect a child's data, not to regulate the nuanced emotional and psychological harm from these new parasocial relationships with AI. And the fact this document was leaked in the first place suggests a serious battle is raging inside Meta itself between those pushing for rapid product launches and those fighting for stricter safety policies. Meta has until September 19th to comply. The battle lines are drawn, putting one of Washington's sharpest tech critics in a direct confrontation with one of Silicon Valley's most powerful companies. While Meta grapples with that safety crisis, another classic tech rivalry is reaching a boiling point. The most unexpected news in the smartphone world today has to be this. Apple's fortress in the US market is showing cracks, and its oldest rival is the one swinging the sledgehammer. New numbers show that in a single quarter, Apple's market share crashed from 56% down to 49%. At the same time, Samsung's share surged from 23% all the way up to 31%. For the first time in over a decade, Apple is showing real turbulence on its home turf. However, if you zoom out, you'll see another layer of strategy at play in the supply chain. Samsung has a massive advantage because it manufactures many of its own components and has facilities in places like Mexico. This helps them avoid the hefty 25% US tariffs on certain South Korean goods. Apple, on the other hand, relies heavily on Chinese suppliers for its screens, and one of its key partners is currently facing a potential US import ban over legal disputes. This puts Apple in a much riskier position when it comes to both cost and supply. So, what's Samsung's secret weapon? It's all about the screen, but not bigger screens, folding screens. But a new screen is only as good as the software that runs on it. Samsung has features like Flex Mode, which splits the screen when it's partially folded. And while big apps like YouTube and Netflix have adapted to this, many other apps haven't. They just look like stretched out versions of their normal selves. This is what some in the industry call the foldable app gap. The hardware is futuristic, but the app ecosystem is still playing catch up. While the iPhone has looked basically the same since 2017, Samsung is betting the farm on its futuristic foldable phones, like the Z Fold 7. The buzz is real, with one YouTuber live streaming, bending the phone over 200,000 times to an audience of millions. Now, get this. While that test is impressive, the long-term, real-world durability of these phones is still a major question mark. We're seeing user reports of screens cracking and hinges failing sometimes just after the warranty expires. And the cost to fix them is staggering over $400 to replace the inner screen on a new Galaxy Fold. So while the technology is exciting, the cost of ownership and potential for e-waste are real concerns. Samsung says pre-orders for its latest foldable are up 25% over any previous model, with sales outpacing its predecessor by nearly 50%. But here's the real kicker, the price. Apple's most expensive iPhone tops out around $1,600. Samsung's new foldable, it goes for over $2,400. They're not just competing, they're creating a new premium category that Apple isn't even in. And Samsung is trying to justify that price tag with more than just a cool hinge. Their big marketing push now is that foldables are the ultimate device for AI. The idea is that the larger screen space is perfect for advanced AI features like generative edit, which lets you manipulate photos in ways that would be clumsy on a smaller screen. The question for us is this a genuine user benefit or a clever marketing story to sell a very expensive product? This all leads to the billion-dollar question. An analyst at JP Morgan is now on the record predicting Apple will be forced to respond, launching its own foldable iPhone in 2026. A Samsung executive claims there are no longer trade-offs towards owning a foldable device, declaring the technology is ready for prime time. And, this actually fits Apple's classic playbook perfectly. They are masters of the late adopter strategy. They let competitors like Samsung work out the kinks like those screen creases and durability issues. Research suggests Apple is already working with suppliers on a truly crease-free display. Their goal isn't to be first, it's to be the best. They are betting that their brand loyalty is so strong that customers will wait for the perfect foldable, even if it costs upwards of $2,500. We were just talking about the hardware battle between Samsung and Apple, but the competition over the chips inside those phones is escalating into a matter of national security. The United States government is reportedly considering a move that would shock the free market, taking a direct stake in the struggling chipmaker Intel. The news sent Intel stock soaring, closing the week up 23%. But the story isn't about a simple investment. One top tech analyst is calling the potential intervention essential for national security. In a blunt interview, he said, "We're all capitalists. We don't want government to intervene and own private enterprise, but this is national security." The argument is that the US can no longer rely on foreign companies like Samsung and TSMC to produce the world's most advanced chips. This is where the situation takes a more complex turn, potentially creating a delicate situation with our key allies. Interestingly enough, both South Korea's Samsung and Taiwan's TSMC are already making massive investments to build factories on US soil in Texas and Arizona, respectively, partly to take advantage of government incentives. A direct US government stake in their main competitor, Intel, could be seen as a vote of no confidence, complicating these crucial relationships. And the criticism of Intel is scathing. The analyst Gil Luria went on the record stating, "Intel has had many opportunities over decades to get it right, and it hasn't, so we need to intervene." But why hasn't Intel gotten it right? The core issue isn't just about money. It's about deep-seated technical and cultural problems. For years, Intel fell behind because it got stuck on its 10-nanometer chip process, which led to major production delays. This was compounded by a corporate culture that was reportedly risk-averse and slow to adapt, a stark contrast to the nimbler model of TSMC. The big question is whether government cash can actually fix these core issues. He added that if the government is going to give Intel unfair advantages, it wants a piece of the business. So what kind of unfair advantages are we talking about? It's a crucial point because this goes way beyond a simple cash infusion. The government could give Intel preferential treatment on defense contracts or alter regulatory hurdles to favor it over competitors. These actions could seriously distort the free market, and as research from organizations like the IMF has warned, such policies risk propping up inefficiency rather than fostering true innovation. This comes after Intel has already been awarded $7.9 billion from the CHIPS Act, and a meeting between its CEO, Lip-Bu Tan, and President Donald Trump, which occurred after the president had called for the CEO's resignation over alleged ties to China. The push for government control is being fueled by warnings from tech leaders like OpenAI's Sam Altman, who have compared the rise of superintelligent AI to the next wave of nuclear proliferation. This is a powerful analogy. If we truly believe that advanced AI is like nuclear weapons, it implies that the technology behind it, especially cutting-edge chips, shouldn't be left to the free market at all. The end game of this comparison is treating AI development and chip manufacturing like a state-controlled weapons program. The implications are staggering. This sentiment was echoed in the starkest terms possible. Luria compared the situation to a critical military vulnerability, stating, "We can't rely on somebody else making shell casings for our nuclear arsenal. We have to get it right." When you look at the historical context, we've actually seen this movie before, just not in the tech sector. The US government has taken control of industries like coal and steel during national crises. So if the government can take a stake in a chip maker today, what stops it from doing the same tomorrow to a critical AI company or a cloud provider? That is the real unanswered question. And all those national security level chips for the AI revolution, they need an almost unbelievable amount of power. That brings us to our final story, where the biggest names in tech are sounding the alarm. The United States is on the verge of losing a staggering 60 gigawatts of planned solar capacity, and the groups raising the alarm are Google, Amazon, and Microsoft. They're in a high-stakes standoff with the US Treasury, warning that the entire AI revolution is on the line because of the insatiable power demand from data centers. The situation presents a fascinating duality, though. These same companies have made huge public commitments to being 100% renewable. Yet, reports show that only a tiny fraction, around 6% of their massive lobbying budgets, actually go toward climate policy. This raises a tough question. Are they prioritizing rapid, low-cost energy over the rigorously green projects they champion in public? Let me put this in perspective for you. The power draw from new AI data centers is so immense it's destabilizing regional power grids. In places like Virginia and Ohio, a massive build-out is underway. Projections show that by 2028, data centers could consume up to 12% of all electricity in the United States. You know, this isn't a distant problem. It's already causing electricity rates for regular homeowners to spike. So how does this actually work? Well, it's not like Google gets a check from the government. The magic happens through something called a power purchase agreement, or PPA. A solar developer uses a federal tax credit to help finance a new solar farm. Then a company like Microsoft signs a long-term contract to buy that power at a fixed, often lower price. The developer gets funding and big tech gets predictable, clean energy. It's a system that has fueled massive growth in renewables. But now the Treasury is considering tightening the rules for those subsidies. What really brought this to a head is the argument over the definition of started construction. For years, a developer could qualify for a tax credit under the 5% safe harbour rule by just spending 5% of the project's cost. The Treasury is proposing to eliminate that rule, requiring instead that significant physical work must be underway. The goal is to stop what some call paper projects from claiming subsidies without ever actually breaking ground. In response, the Data Center Coalition, representing big tech, sent a letter with a direct warning. They wrote, quote, "Any regulatory friction that slows down deployment of new generation today directly impacts our ability to meet AI-era electricity demands tomorrow." And this isn't just a lobbying tactic. China is moving incredibly fast on this front. Their government is mandating that new data centers in key regions get at least 80% of their power from renewables by 2025. They are pouring state subsidies into this effort and are already the world's top producer of renewable energy. So the threat of the US falling behind on the energy front of the AI race is very real. And if you think that's just talk, consider the numbers. The data center industry contributed $3.5 trillion to the nation's GDP between 2017 and 2023. They're arguing that the engine of the modern digital economy could stall. The Treasury is expected to issue its updated guidelines as soon as August 18th. This all begs the question, will the government back down in the face of pressure from big tech, or will it risk pulling the plug on the power source for the AI boom?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.